Welcome back, students. We were discussing about the standard deviation and the variance expected return of the available asset classes in the market, like bond fund and stock fund. And this section we will see if we put a portion in one of the asset class, another and the remaining portion in another asset class. We are selecting two risky assets, two different asset classes, then how our expected return, variance, and standard deviations are being calculated. Here you see, for example, we are putting 40% in our stock fund, in the stock fund, and 60% of our money in the bond fund. And the expected returns we have already calculated in the previous section. So, if we are putting 40 and 60 in the stock and bond fund, how our expected return is getting affected, how our standard deviation is getting affected. Let us calculate that. Go to the spreadsheet, please. You have now, you can see here the asset allocation here. The allocation, you can write asset allocation. Asset allocation here, and 40% in the stock fund as we have decided, and 60% in the bond fund. You are not much risk taker, for example, so you are putting 40% in stock fund and 60% in the bond fund. Now, as per the formula we have seen in the slide, expected return is equal to weight of the return multiplied by the return possibility of return plus weight of the return 2 possibility of return 2, means asset class 1, asset class 2. So here asset class 1 is stock fund, asset class 2 is bond fund. So let us do it here where it is, yes. First of all, we calculate the expected return or the possibility of return in the asset allocation. What is the asset allocation? 40% in stock fund. So 40% multiplied by minus 37%. Where from minus 37 came? The return from the stock fund, column C. You can find in severe recession, your return is minus 37 from the stock fund. So 40% multiplied by minus 37 plus 60% multiplied by minus 9. Where from minus 9 came? Column H. The possibility of return in severe recession in bond fund will give you minus 20.20. Similarly, 40% multiplied by minus 11%, that is column C, plus 60% multiplied by 15%, column H, will give you 4.6. Similarly, 40% multiplied by 14%, column C, 60% multiplied by 8%, column H, will give you 10.4. Similarly, 40% multiplied by 30%, column C, plus 60% multiplied by minus 5%, column H, will give you 9%. This is the different scenarios, possibility of return from the portfolio you selected. 40% stock, 60% bonds you selected. Then the possibilities of returns are given here. Then what happens? The possibility of returns are here, but you need to multiply the probability with the possibility. So the same way you calculated for stock and bond, you have to calculate for your portfolio. Therefore, in column N, you multiply the possibility of return multiplied by probability of return. That means minus 20.20 multiplied by 0.05, column B, will give you minus 1.01. Similarly, 4.60, column M, multiplied by 0.25, B8, will give you the multiplication of possibility of return multiplied by probability of return, expected return of your portfolio under mild recession. Expected return of your portfolio under normal growth will be 10.4 multiplied by 0.4, 4.16. This way you calculate. And when you make the sum total in the whole economic scenario under different scenarios, your expected return, your portfolio expected return will be 7%. This 7% also can be calculated using a direct formula. Go to the PowerPoint, please. You see, there is a direct formula here. We have used the ROR formula. ROR, rate of return formula, we have used here. In this spreadsheet, we have used the ROR formula. How we have used the ROR formula? Rate of return formula, that is possibility of return multiplied by probability of return is equal to the expected return. So we have used the weight multiplied by return from stock plus weight of bond multiplied by return of bond. Individual scenarios like severe recession, mild, normal, boom, we calculated. That is ROR formula we have used. You can use ERR formula, that is expected rate of return. Directly you can calculate. We have done it. Can you go down? Expected return here I calculated. Just go down to N16. Can you go to cell number N16? There it is calculated expected return. How it is calculated? Very simple. We have used the formula. Expected return is equal to weight of return. Yeah. Weight of return, weight of investment multiplied by expected return of bond. So weight of bond, expected return of bond plus weight of stock, expected return of stock. And you know, is equal to weight of bond is how much? Weight of bond is 60% multiplied by expected return of bond is how much? Expected return of bond is 5% plus weight of stock multiplied by expected return of stock 10%. That also will give the same 7% which we calculated here. That's why you can see here, you can see true. I have used a logical formula here. If this 7% is equal to this 7%, then you give me true or else give me false. For example, see, I will make the formula little wrong. D11, instead of D11, I will make D10, for example. You see, it is coming automatically false. That means I made a mistake. So if I change it to D11, it is coming true. So I use the logical test here. If it is equivalent to this is equal to this, then it is true. Otherwise, it is false. So this is the way we can calculate the expected return using the ERR formula here. Similarly, we can calculate the variance also using the variance formula. Before that, let us calculate the variance from this data set. We have calculated the expected return here. Then from each return, let us calculate the deviation. Deviation minus 20.20 minus 7. 7 is the expected return. Minus 20.20 minus 7 is equal to 27.20. 4.6 minus 7 is equal to minus 2.4. 10.4 minus 7 is equal to 3.4. 9 minus 7 is equal to 2. We got the deviations. Same way we made the square deviations to make the negative sign is removed. Now normal with the square deviation we will multiply the probability, and once we add together we get the variance, then we square root, we can get the standard deviation. Students, can you notice here, by making a proper diversification, why I am saying proper diversification, still I cannot claim proper diversification, but seeing this I can say, you see, if you are putting your 100% money in stock fund, your standard deviation will be 18.63. If you are putting 100% in bond fund, your standard deviation would be 8.27. But you're putting 60% in bond fund, 40% in stock fund, and what you are doing, you brought down the standard deviation much lower. You see now, the standard deviation is only 6.65. It is much less than this 8.27. Much less than 8.27. And the expected return also, your bond fund is only giving 5% return. And standard deviation 8.27. Whereas your portfolio is giving 7% with this 40-60 diversification. Instead of putting, some people have misconception. What they say, if I'm old fellow, I don't want to take risk, I will put all my money in bond fund. Wrong. If you are putting all your 100% in bond fund, you see your expected return will be 5%. I11. And your standard deviation will be 8.27. So I am writing here so that you can understand. If you are putting all your money in a bond fund, for example, if you are putting all money in bond fund, then your return is how much? Your return is 5%. Whereas your standard deviation is 8.27. If you are putting 40% in stock, 40-60 if you are creating a portfolio where you are putting 40:60, 40 in stock, 60 in bond, then your expected return is 7%. And your standard deviation is much lower than the bond standard deviation, 6.65. 6.65. So this is called, just go to the next slide, mean variance criterion. This is called mean variance criterion. Mean variance criterion. What is mean variance criterion? If in any of the return, if A is greater than B, return of A is greater than B or equal to B, but standard deviation of A is less than or equal to B, then the portfolio A will dominate portfolio B. You see, return of A is greater than return of B, yes. And standard deviation of A is less than standard deviation of B, yes. Then portfolio A dominates portfolio B. Or here portfolio B dominates portfolio A. Here portfolio B dominates portfolio A. Why? Because portfolio B's return is greater than portfolio A's return. And portfolio B's standard deviation is less than portfolio A's standard deviation. In this case, return is higher, standard deviation is lower. Then you can say portfolio B dominates portfolio A. Alright students, in this case we can say portfolio B dominates portfolio A as per the mean variance criterion. And we have seen here in this scenario, instead of investing 100% in the bond fund, if you are investing 60% in bond, 40% in equity, then your standard deviation is much reduced from 8.27 to 6.65. Whereas your return is increased from 5 to 7%. Therefore, here the return is increased by 2%. Why this portfolio B dominates portfolio A? Because the return is exceeded by 2%. your B's return is more than A's return by 2%, and B's standard deviation is 1.62 less than A standard deviation. That means standard deviation is less, return is more. Then we can call portfolio B dominates portfolio A. I hope this is clear. So this is the way we can calculate and standard deviation. How we calculate? We calculate the variance we calculated, and standard deviation after multiplying the probability. We calculated the variance and standard deviation for your portfolio. Now, for example, the main interesting thing, because once you do the modeling, rest of the things you need not make time and again. For example, your asset allocation, instead of 40-60, you got 40-60, and you see your portfolio is better than investing in bond fund because your return is high, risk is low. And if, for example, make it 50-50, stock fund 50, bond fund 50, then you can find here this bond fund return is equal to, I will write the funds return directly. Bond fund return is equal to this, and bond fund standard deviation is equal to this, and your portfolio return is equal to 7.5, and the bond funds standard deviation your fund standard deviation is how much? 8.15, right? It's equal to 8.15. Enter. You see now, if you are investing 50-50 instead of 40-60, I invested 50-50, for example, then what happens? Your return is high, your fund's return is higher than the bond fund 2.5%, and your standard deviation is lower than the bond fund by minus 0.11. So still your portfolio is better than the bond fund. Alright? But if I am investing in 40% here, situation is far better. Why? Return is high by 2%, but the standard deviation is low by minus 1.61. So this is a kind of golden chance. Your return is high, your standard deviation is low. Then mean variance criterion suggests your portfolio outperforms, or your portfolio dominates the portfolio A, or portfolio A or bond. Portfolio B or your portfolio dominates the bond portfolio. So this is the way we make the kind. For example, just for a minute, 100% if I invest in stock fund, 0% I will invest in bond fund. Then see the magic here. If I invest 100% in stock fund, what is the standard deviation? 18.63. This is nothing but 18.63. This is nothing but the standard deviation of the stock fund. You see here? This is nothing but standard deviation of the stock fund. Same like if you are investing 0% in equity, 100% in bond, your standard deviation is 8.27. That is nothing but the standard deviation of the bond fund. Check it. 8.27 here, 8.27 in the column L, 8.27 in the column Q. Because you are putting 100% in bond fund, that means you see here 5%, 8.27, 8.27. So no, as per mean variance criterion, no, your fund is not dominating the bond fund, because they are both getting the same return, same standard deviation. So this is the way we calculate the mean variance analysis. And again, go to the PowerPoint, please. There is a instead of calculating from the data set, from the data series, we calculated the variance and standard deviation. You can calculate the variance and standard deviation using the formula for variance and standard deviation. What is the formula? The formula is weight of bond fund multiplied by standard deviation of bond fund square, weight of stock fund, standard deviation of stock fund square, plus 2 multiplied by weight of bond, standard deviation of bond, weight of stock, standard deviation of stock, multiplied by correlation between bond fund and stock fund. This is the way we calculate the directly. You see here in your spreadsheet, go to the variance. The formula is being used here. You can check the formula here. Weight of bond multiplied by standard deviation of bond square plus weight of stock multiplied by standard deviation of stock here square plus 2 multiplied by weight of bond, standard deviation of bond, weight of stock, standard deviation of stock multiplied by correlation between the bond and stock fund. Now it is a question now how we calculate the correlation and covariance. First of all, to calculate correlation, we calculate covariance, or calculating covariance, you need to calculate correlation, either of the two. So how we do it? We calculate, already you have bond fund deviation. Here is the deviation, column E is the deviation of stock fund, and column J is the deviation for the bond fund. What you do here, you multiply the deviation of stock fund multiplied by deviation of bond fund. You multiply, then you multiply this with the probability, then you total it, then you get the covariance. You understand now? So deviation of stock fund multiplied by deviation of bond fund, then you multiply with the probability, then you get the column B, the probability multiplied by the product of deviation, and you make the total, you get the covariance, and correlation is equal to covariance divided by standard deviation of bond fund divided by standard deviation of stock fund. So the correlation formula is equal to covariance of the stock and bond divided by standard deviation of bond multiplied by standard deviation of stock. It comes minus 0.49. That means it is a perfect diversification. Why? Always this correlation varies from 0 to 1 to minus 1. So at least you should not diversify securities having positive high correlation. They will not be helpful. You should always pick stocks and securities having low correlation or no correlation or negative correlation. Low correlation means 0.1, 0.2, these are the low correlation. Zero correlation means no correlation. Zero, when the correlation becomes zero, there is no correlation. And practically getting no correlation is not that easier. Negative correlation, you can see here negative correlation. Bond fund and stock fund, they are negatively correlated from each other, minus 0.49. That is why when you saw only bond fund gives you 8.27 standard deviation, but 60-40 gives you 8.27, 60 in the 40 in the stock fund, 60 in the bond fund. Then your standard deviation is much reduced. From 8.27, it came 6.65, and from equity 18.63 to 6.65. That means it's a perfect diversification. Only the systematic risk remains. The total or non-systematic risk is reduced. Why? Your diversification having negative correlation assets. Bond fund and stock fund, they are negatively correlated. If the assets are negatively correlated, they are best pick for diversification. If the assets are negatively correlated, they are the best pick for diversification. If they are positively correlated, might not be good for diversification. If they are low correlated, low positive correlated, okay. If they are high correlated positive, never go for diversification. They will not reduce any kind of thing. For example, what I can do, just I will change the data. For example, I will change from 9 to 39. Okay, you can see the correlation is now, you reduce the correlation from -49 to -02, and again little I will change the data of the bond fund. For example, the data of the bond fund here, for example, I will make it 1.5, okay, negative. You see now, they are positively correlated, 0.42 positively correlated. Students, please see. Before it was negative 0.49. Now it is 0.42. How I have done this magic? I have similar return I have taken for stock fund and bond fund. Here also, here the return is minus 37. Here I made is minus 39. Here it is minus 2.75. Here it is minus 11. I made it here minus 1.5. Here it is 14. Here I made it, for example, I made it 10. Further, it will be positive correlated. You see, if I go here 0.41, therefore they are not good for diversification. You can see this. You can see with 40-60 diversification also, your standard deviation is 11.89. But that is equivalent to the standard deviation of the bond fund. Not much reduced. And the return also, if you see the return, that return also 7.19. The return also not very great. You can see the return here is 11. Where is the return of the allocated fund? Here. Rate of return is 9%. So you don't have a much different performance. Why? Your return of bond fund is already, your return of bond fund is 11 point, how much is the return of bond fund? 18%. And your standard deviation is 11.14, whereas this is 11.89, no much difference. But if I make it like previous, see, I made it bond funds as per the original. You see the difference now? The correlation is minus 0.49. So, this is a good pick for diversification. There is another formula here you can see. We have seen the formula for correlation is equal to covariance divided by standard deviation of stock fund multiplied by standard deviation of bond fund. Similar way, you can see you will be provided with data for any three. You have to calculate the fourth one. Here four things are there: covariance, standard deviation 1, standard deviation 2, and correlation. Four data are there. Any three will be given, fourth will be missed, and you will be given in multiple choice question. For example, covariance given, standard deviation stock, standard deviation of bond given. Here in this case, we calculated the correlation. Why? Covariance was here, standard deviation of bond fund was here, standard deviation of stock fund was here. So we have used covariance divided by standard deviation bond multiplied by standard deviation stock is equal to correlation. Sometime you will be given with correlation, standard deviation of stock, standard deviation of bond, covariance is asked. Then this denominator in the right side goes to the left side, becomes multiplied with the correlation. You can make the, and sometime correlation, covariance, and one of the standard deviation will be given, the other standard deviation will be asked. Correlation given, covariance given, standard deviation stock given, standard deviation of bond is asked. Sometime correlation given, covariance given, standard deviation of bond is given, standard deviation stock is asked. So anyway, you can have any three data given, fourth data you can calculate. using manipulating the formula. This is the way we make the kind of calculation of standard deviation, correlation, covariance. We see whether the kind of diversification is